By 2024, Nike was still generating more than $50 billion in annual revenue and remained one of the largest athletic brands in the world. Its products continued selling across North America, Europe, China, and multiple international markets, while the company maintained global sponsorships with major athletes and sports organizations. From the outside, the business still appeared dominant, highly profitable, and structurally stable. However, pressure had started building inside the system several years earlier. Nike had spent years pushing aggressively to direct-to-consumer sales through its own stores, apps, website, and SNKRS platform, while reducing dependence on wholesale retailers like Foot Locker and other third-party partners. The strategy initially worked because digital sales expanded rapidly, margins improved, and investors rewarded the company for gaining tighter control over customer relationships. But the transition also made the system more dependent on Nike's own ability to forecast demand, manage inventory, and move products efficiently across global markets. When pandemic disruptions hit manufacturing and shipping networks, those dependencies became harder to manage at scale. Factory shutdowns in Vietnam delayed production, inventory arrived at the wrong time across multiple regions, and some categories became oversupplied, while others faced shortages. At the same time, performance running began shifting toward newer brands like Hoka and On, which were releasing products faster and gaining traction with younger consumers and serious runners. Nike still controlled enormous market share in basketball, lifestyle footwear, and sportswear, but some of the fastest-growing segments of the athletic market were no longer moving entirely in Nike's direction. Meanwhile, investors began questioning whether the company's size, centralized structure, and slower product cycles were reducing its ability to react to changes happening across the industry. The problem was not that Nike stopped being powerful. The problem was that one of the most optimized retail systems in the world had started becoming slower than the market it once controlled.
Nike's rise into a global retail powerhouse was built over decades through a system that combined athlete influence, mass manufacturing, global distribution, and cultural positioning at enormous scale. The company expanded aggressively during the 1980s and 1990s by turning athletic footwear from a sports product into a mainstream consumer category connected to identity, fashion, and status. Partnerships with athletes like Michael Jordan transformed Nike from a performance brand into a global cultural force with pricing power that competitors struggled to match. The success of Air Jordan alone helped create a product ecosystem where footwear releases generated recurring consumer demand far beyond traditional sports markets. As the business expanded internationally, Nike built a supply chain capable of manufacturing products across multiple countries while distributing inventory through retailers, department stores, branded outlets, and global wholesale networks. This scale created enormous operational advantages because the company could launch products globally, negotiate favorable manufacturing costs, and dominate shelf space across major retailers. By the 2000s and 2010s, Nike had become deeply embedded inside professional sports, youth culture, fitness trends, and sneaker resale markets simultaneously. The company's scale also allowed it to spend billions on athlete sponsorships, marketing campaigns, digital platforms, and product development without placing immediate pressure on profitability. At the same time, strong brand recognition gave Nike room to maintain premium pricing even when manufacturing costs increased. This created a growth engine where marketing reinforced demand, demand increased distribution leverage, and distribution scale strengthened profitability. For years, the system operated with extremely high momentum because nearly every layer of the business reinforced another. Retailers wanted Nike products because consumers demanded them. Consumers wanted Nike products
because athletes, influencers, and sports leagues continuously reinforced the brand's visibility. Investors rewarded the company because revenue growth remained consistent while margins stayed strong relative to competitors. By fiscal year 2021, Nike generated more than $44 billion in annual revenue while maintaining one of the strongest brand valuations in global retail. During the pandemic period, digital demand accelerated even further as online shopping expanded rapidly across multiple regions. Nike responded by increasing investment into direct-to-consumer channels, mobile apps, digital memberships, and owned retail infrastructure. Internally, management believed tighter control over distribution would strengthen margins, improve customer data, and make the business more efficient over time. But the larger and more centralized the system became, the more dependent it became on maintaining perfect coordination between inventory, product timing, manufacturing, shipping, and consumer demand. That dependency would eventually become one of the most important pressure points inside the entire business. By the late 2010s, Nike began accelerating one of the largest structural shifts in its modern business model. The company started reducing dependence on traditional wholesale retailers while pushing consumers toward Nike-owned stores, mobile apps, and direct digital purchasing channels. Management believed the direct-to-consumer strategy would increase profitability because Nike could capture the full retail margin instead of sharing revenue with third-party sellers. At the same time, the company gained direct access to customer behavior, purchasing patterns, membership data, and product demand across different regions. Wall Street responded positively because the strategy improved gross margins and strengthened Nike's control over pricing and inventory visibility. Digital sales expanded rapidly during the pandemic period, reinforcing the belief that the future of the business would rely heavily on Nike-controlled ecosystems. The SNKRS platform became central to this strategy by driving limited releases, digital engagement, and high-demand product launches directly through Nike's own infrastructure. As this transition accelerated, Nike reduced relationships with several wholesale partners and limited product access across portions of its external retail network. The company believed fewer distribution partners would create a cleaner brand image and reduce discounting pressure across the market. Initially, the system appeared highly successful because revenue remained strong, while direct digital channels produced higher margins than wholesale distribution. However, the structure also created new operational dependencies that became increasingly difficult to manage at global scale. When products moved primarily through wholesale networks, retailers absorbed part of the inventory risk because inventory could spread across thousands of external locations. As Nike centralized more control internally, the company itself became increasingly responsible for forecasting demand accurately across multiple regions and product categories. This meant mistakes in product timing, inventory planning, or consumer demand forecasting now created larger operational consequences inside Nike's own system. The model also reduced some of the flexibility that wholesale networks previously provided during periods of sudden market disruption. At the same time, Nike's size created additional complexity because the company was managing enormous product volumes across footwear, apparel, basketball, running, lifestyle, women's categories, and global regional variations simultaneously. As the business became more optimized around efficiency and centralized control, the margin for execution error became smaller. The strategy still generated strong financial performance externally, which made the underlying fragility harder for investors to recognize early. By 2020 and 2021, Nike's direct-to-consumer strategy appeared to producing exactly the results management had promised investors for years. Digital sales accelerated rapidly during the pandemic period as physical retail traffic collapsed across multiple global markets. consumers shifted heavily toward online purchasing, fitness products, and athletic apparel, while lockdowns increased demand for sportswear and home fitness categories. Nike's mobile apps, membership ecosystem, and digital platforms became central to how the company interacted with customers. Investors viewed the transition as proof that Nike could generate stronger margins while controlling more of the customer relationship internally. At the same time, the company continued reducing dependence on traditional wholesale distribution in favor of its own retail and digital infrastructure. Financially, the strategy initially looked extremely successful because digital growth expanded quickly, while direct sales generated higher profitability than wholesale channels. However, the system's increasing efficiency also created deeper operational sensitivity underneath the surface. Nike's global supply chain depended heavily on manufacturing partners across Asia, including major production concentration in Vietnam. When pandemic disruptions intensified, factory shutdowns and shipping bottlenecks began delaying production across multiple product categories. Products that were expected to arrive during high-demand periods started reaching markets late. At the same time, transportation costs increased sharply, while movement of inventory became harder to coordinate globally. Some regions experienced shortages in key footwear categories, while other markets accumulated excess inventory that could not move at the expected pace. This created growing pressure between demand forecasting, manufacturing schedules, and retail timing. Because Nike had centralized more control internally, inventory imbalances now affected the company more directly than during earlier wholesale-heavy periods. The business still appeared strong externally because revenue remained high and brand demand continued globally. But operational flexibility inside the system was beginning to weaken under the pressure of scale, timing disruptions, and inventory coordination problems. The larger the company became, the harder it became to keep manufacturing, logistics, digital demand, and product timing aligned simultaneously across every market. What initially looked like peak optimization was slowly becoming a system that had less room to absorb disruption without affecting growth momentum. As pandemic disruptions began easing across global markets, Nike expected operational stability and consumer momentum to normalize gradually. Instead, a different pressure started emerging underneath the recovery period. The athletic market itself was changing faster than Nike's larger system could comfortably adjust. Performance running became one of the clearest examples of this shift. Brands like Hoka and On expanded aggressively by focusing heavily on running innovation, lightweight cushioning technology, and faster product refresh cycles. Their businesses were smaller, more concentrated, and structurally easier to move quickly compared to Nike's massive global product ecosystem. At the same time, younger consumers and dedicated runners increasingly viewed these brands as more specialized and performance-focused in key running categories. Nike still maintained enormous global brand recognition, but parts of the market were no longer moving automatically toward Nike products by default. Internally, the company also faced increasing pressure around product timing and innovation speed. Several product categories became heavily dependent on retro lifestyle releases and established franchises that had already proven commercially successful. While those products continued generating strong revenue, the strategy reduced urgency around breakthrough innovation across portions of the business. Competitors, meanwhile, were moving faster with new silhouettes, technical running products, and category-specific experimentation. This created a widening gap between Nike's scale advantages and the market's increasing demand for faster adaptation. At the same time, inventory imbalances from earlier disruptions still had not fully normalized across multiple regions. Some products required discounting to clear excess inventory, while other categories remained supply-constrained. The wholesale relationships Nike had previously reduced were also becoming more important again as the company searched for additional distribution flexibility. Management started increasing engagement with key retail partners after years of aggressively prioritizing direct-to-consumer expansion. However, rebuilding flexibility inside a highly centralized system takes significantly longer than reducing it. The company still generated massive revenue and maintained strong global visibility, but operational speed was no longer matching the pace of change happening across the industry. This marked the period where Nike's biggest challenge stopped being scale expansion and became responsiveness under pressure. By 2023 and 2024, the pressure inside Nike's system was becoming increasingly difficult to hide from investors and the broader market. Revenue growth began slowing across several important regions, even though global demand for athletic products remained active overall. This created a more dangerous situation because the problem was no longer category weakness alone. The problem was that portions of the market were still growing, while Nike was losing relative momentum inside them. Performance running became one of the clearest pressure points as brands like Hoka and On continued expanding rapidly across North America and international markets. At the same time, Nike faced criticism that parts of its product pipeline were becoming too dependent on existing franchises and retro releases instead of breakthrough innovation. Investors started questioning whether the company's size and layered operational structure were reducing its ability to respond quickly to market shifts. Inventory pressure also continued affecting profitability across portions of the business. Excess inventory forced discounting activity in some categories, which placed additional pressure on margins and brand positioning. At the same time, consumer spending patterns became less predictable as inflation and economic uncertainty affected multiple global markets. China, historically one of Nike's most important growth regions, also became more volatile due to weaker consumer confidence and slower retail recovery. Digital growth rates normalized after the pandemic surge, removing one of the major expansion drivers that had previously supported investor optimism. The company responded by accelerating operational adjustments, inventory cleanup efforts, and wholesale re-engagement strategies. Management also increased focus on improving product innovation speed and restoring stronger alignment between supply, demand, and category growth. However, the scale of Nike's system made rapid correction extremely difficult. The company was operating across thousands of retail locations, massive manufacturing networks, global shipping systems, digital platforms, sponsorship obligations, and multiple regional product strategies simultaneously. Even relatively small forecasting errors could now create billions of dollars in operational consequences across inventory and distribution systems. Meanwhile, competitors with narrower product focus continued adapting faster in key growth categories. The market was no longer rewarding size alone. It was rewarding speed, specialization, and the ability to respond quickly to changing consumer behavior. Nike still remained one of the largest athletic brands in the world, but the business was no longer moving with the same momentum that had defined its earlier expansion cycle. For the first time in years, investors were no longer evaluating the company only on dominance. As pressure continued building across the business, Nike entered a phase focused less on aggressive expansion and more on stabilizing the system underneath it. Management began shifting attention toward repairing operational flexibility, reducing inventory pressure, and improving execution speed across key categories. One of the clearest changes involved rebuilding relationships with wholesale partners that had previously been reduced during the direct-to-consumer expansion strategy. Retailers that were once viewed as less important became strategically valuable again because they provided additional distribution flexibility during periods of uneven demand. This marked a significant reversal from the earlier belief that tighter centralization alone would produce stronger long-term growth. At the same time, Nike accelerated efforts to improve product development speed and category responsiveness. The company increased focus on performance innovation, running products, and faster design cycles as competitive pressure intensified across those segments. Leadership also faced growing investor expectations to demonstrate that operational problems were temporary rather than structural. However, correcting a system of Nike's scale involved far more complexity than launching the original expansion strategy. The company was managing manufacturing coordination across multiple countries while simultaneously balancing inventory levels, digital commerce systems, regional demand shifts, sponsorship obligations, and retail relationships. Changes inside one layer of the system often created pressure somewhere else. Reducing excess inventory too aggressively risked weakening retail availability. Increasing wholesale distribution too quickly risked reducing direct-to-consumer profitability. Accelerating innovation cycles required faster coordination between design, manufacturing, logistics, and retail timing. At the same time, the company still needed to protect brand positioning while increasing operational flexibility. This created a difficult balancing problem where Nike had to become faster without damaging the premium structure that helped build its dominance in the first place. Internally, the focus increasingly shifted toward restoring synchronization across product timing, inventory movement, digital demand, and regional execution. Investors, meanwhile, continued monitoring whether growth stabilization would actually translate into stronger long-term momentum recovery. The market no longer assumed that Nike would automatically regain leadership speed simply because of brand size and historical dominance. The company was still enormously profitable and globally recognizable, but its next phase depended on whether management could rebuild responsiveness inside a system designed primarily for scale and efficiency.
Nike did not collapse in the way many failed companies do. The brand remained globally recognizable, highly profitable, and deeply embedded across sports, fashion, and consumer culture. Even during periods of slowing momentum, the company continued generating tens of billions of dollars in annual revenue, while maintaining one of the largest athletic distribution networks in the world. However, the pressure that emerged inside the business revealed something more important than a temporary slowdown. It revealed how difficult it becomes for a highly optimized global system to remain flexible once market conditions begin changing faster than the organization itself. For years, Nike's scale created advantages that competitors struggled to match. The company controlled athlete influence, retail visibility, manufacturing leverage, cultural relevance, and premium pricing power simultaneously. But scale also increased operational complexity. As the business became larger and more centralized, execution speed became harder to maintain consistently across every category and region. At the same time, newer competitors entered important growth segments with fewer operational layers, faster product cycles, and more concentrated category focus. The market gradually shifted from rewarding size alone toward rewarding specialization, responsiveness, and speed. Nike's challenge was no longer simply protecting market dominance. The challenge became rebuilding flexibility inside a system designed primarily around efficiency, control, and scale coordination. This shift forced the company to reconsider several assumptions that had previously driven its expansion strategy. Reducing wholesale exposure improved margins, but it also reduced shock absorption capacity during periods of inventory imbalance.
Heavy dependence on digital growth accelerated profitability during the pandemic period, but it also increased pressure once digital demand normalized. Optimization improved consistency during stable periods, but it reduced adaptability once supply chains, consumer behavior, and competitive dynamics started changing simultaneously. By 2024, Nike was still one of the largest athletic companies in the world, but investors were evaluating the business differently than they had during its earlier expansion years. The conversation was no longer focused only on brand dominance or historical growth strength. It increasingly focused on whether the company could regain the responsiveness that once helped it stay ahead of the market for decades. At the same time, competitors like Hoka and On demonstrated how quickly momentum can shift inside categories that were once heavily controlled by larger legacy brands. The broader industry also changed during this period.